Hi Arvind, good afternoon. This is Jignesh here from investmentguruindia.com. Welcome to the show. How are you?
I'm very good, Jignesh, and thank you for inviting me. Pleasure to speak to you guys.
Thank you for your time, Arvind. Arvind, Indian markets are seeing unprecedented time as far as COVID cases are concerned, and there is a concern in the investors' mind. Whereas in the global economy, right now we're seeing a complete turnaround. How do you see markets from an Indian investor's perspective from here on?
So, for the markets and for the economy, Jignesh, I think the most important point is, how do we deal with this second wave, right? It is exponential. It's growing at a much faster pace than what it was in the first wave. It is spreading into rural areas. Yeah, we didn't have that scenario in a big manner in the first wave, but now tier 2, tier 3 towns, rural areas are getting impacted, which didn't happen in the first wave. So it's different, and every thought, action, idea should be in terms of how we control it. Ideally, if there was if there was a time to do a national lockdown, it should have been now, where you could have done a 1 month, 1.5 month national lockdown, control the virus, and the government could have then supported the economy through income support, jobs, Narega, food, and then you come out of a national lockdown in a much better manner. Virus is under control. People also have some income support. But what we are seeing now is different. Some states are going into lockdowns. Some states are announcing some income support. Most states haven't done it. They just announced lockdowns, which means people are losing their income or livelihood activity, but they might not be compensated. So it is complicated. But this is the most important aspect. As a government, as corporate India, as investors, we have to first deal with the impact of the virus and then look at the market. In terms of equities, if there is a national lockdown, or if many more large states, go into a stricter lockdown as because their health systems are getting overwhelmed, that should be a negative for equity markets. Although corporate India is kind of better prepared, they have their standard operating procedures. They know how to operate in lockdown. They know how to run their factories with social distancing and stuff like that. So much better than the first lockdown. And also this, even though there's a strict lockdown, it won't be as strict as what we had in 2020. So corporate India is better placed. Balance sheets, at least for the listed large corporate India, is better. But having said that, given where valuations are, given the market is, and given the likely impact on the economy, if it's a soft lockdown, maybe 1 or 2% of GDP. If it's a very hard lockdown, then the GDP activity can fall more. It kind of seems a bit negative in the short term. In the short term, it seems negative for the equity market. On the other hand, government bonds, that I won't say a big positive. We don't see bond yields going low a lot, but markets were already expecting that the RBI will start hiking interest rates or tightening liquidity and normalizing the monetary policy. I think that is delayed for sure. RBI will allow and wait and give time for the economy to adjust to the second wave and support the government's efforts and the corporate India's efforts in dealing with the virus. So which would mean that the interest rates will not increase by much. Liquidity will remain ample. RBI will continue its open market operations and supporting government bonds. So the government bond yields will remain in a range bound. Short-term interest rates which had moved up, bond yields should come down or will be range bound. So it's relatively slightly more positive for government bonds as against equity in the short term. If you see, you asked me about the global economy, and I mean, India currently is kind of an outlier in some sense, because if you look at the US, if you look at EU, if you look at UK, they've had a much better control over the virus. The vaccination drive is in a superb drive there, and the economy is much more supported by fiscal action. You look at China, same, right? They've controlled the virus, they have better vaccination, and the economy is on a roll. Government support is pretty significant. So in the short term, for that matter, India might seem outlier because it's struggling. Global headline news is very bad coming out of India, and we've already seen some outflows, right? Foreign outflows over the last 2-3 months, 2 months at least, have been negative. This is after we got significant amount of inflows, so some amount of outflows was expected. It might increase in case the lockdown is severe and the virus strains are are longer. Uh, but you have to understand that India, from a long-term perspective, India has to kind of convince the global world that we can deal with these situations and then come out stronger. So what steps and what actions the government take from here on to both control the virus and to support the economy and support incomes and employment. I think that will pave the way for how we see going forward, at least in the next 1 year.
Right, right. What do you think about gold as an asset class from here on?
So, if you followed quantum, we've always said gold is kind of a portfolio insurance, right? Every Indian is a natural buyer of gold, but every Indian investment portfolio should have some allocation to gold. You can be 5%, 10%, 15 to 20%. That allocation we need to make to gold at all times. And I very jokingly always say that, buy gold and hope it falls, because when gold falls, that's the indication that other things are going well, right? Your economy is doing well, your jobs are doing well, your incomes are doing well. When gold increases in dollar price or in rupee terms, it's a sign of nervousness. Markets are nervous about something, the economy is nervous about something, there is some, a potential pitfall. So that's the role of gold. And you've seen it did very well in 2019 to 2021, right? As there was a global slowdown or crisis because of COVID, gold gave you that return and and kind of buffered your portfolio in some sense. Prior to that, 4-5 years, gold did nothing. So always look at gold from that perspective. It's a portfolio stabilizer in your overall portfolio that you make. So I don't have an explicit call on gold, but my view has always been this. This is how you need to allocate the gold.
Right. So, in these tough times, it is important that, we manage our asset allocation very diligently. Whether, we have seen some serious upswing in the equity market and, people are having a lot of profit. It would have been advised that, at least they book some profits and, redo their asset allocation rather than going overboard. So, what is your suggestion on this?
So I have a kind of broader solution to this. We've been vocally stating about something called 24-80-20. The 24-80-20 rule is that depending on the job that you have, depending on your business or the job that you hold, how stable it is, what kind of salary stability that you see, or on a business stability, keep 6 to 24 months of your expense that you have, your monthly expense, separately in a safe environment. It could be hard cash, it could be bank savings account, it could be liquid funds. It should be in a place which can never have any risk. And especially people would realize the benefit of this, especially after COVID, where some people have not had incomes for 2-3 months, they've lost jobs, they've lost the ability to run their business, and this emergency corpus has helped them tide over their EMIs or their monthly expense or their child's education, school education, whatever. So keep this up separate. Now, for somebody who has a stable job, could be 6 months of expense. Somebody who's in a very volatile business like the restaurant, could be 24 months of expense. Keep that very, very safe. The rest, after you do that, do 80% equity, 20% gold. So, this makes it very, very simple. And you can keep, looking at this every 6 months, every 1 year, depending on how it's moved. So if you think that 80% equity, you always have the allocation that has become 90-95, cut it down and bring it below the 80%. But this sounds difficult, but it's very, very easy. So many of my friends who have done this, especially over the last 2-3 years, benefited because of, the fact that you are comforted, you have the emergency corpus, and you are allocated to a asset class like equity, and then you are buffered with gold. It just makes your life very, very simple. And you can pick 2, 3, 4 funds, in equities and one fund in gold or the sovereign gold bond or the gold ETF. And your emergency corpus is in liquid funds, fixed deposit savings, and 1 or 2 debt funds. That's it. You can meet all the asset allocation. Right now, since you asked the question on market, of course, equity market, as I said, given the scenario that we are in terms of that we might enter into a stricter lockdown, the equity markets could take a hit because growth will take a hit, right? Growth will again come under pressure, and the government might not have the same fiscal resources to support the economy in the way they did in last year. So from that perspective, if you are very heavily allocated to equity, maybe for a very short period of time, or for depending on asset allocation. Equities, you may want to cut equity exposure a little bit.
Right. Do you have any product which is there which has got multi-asset in itself, which automatically regulates itself?
So, at Quantum Mutual Fund, which is the 100% subsidiary of Quantum Advisors that I work, we run a Quantum multi-asset fund, which allocates into equity, debt, and gold. Okay. The gold is like a 15% combined, like a allocated exposure, and the fund manager makes a choice between equity and debt depending on relative valuation. So just to give you a perspective, in March 2020, the equity weight had increased to 50%. And as equities have done well over the last 1 year, that weight in equities has come down to 25%, and debt has gone to 60%. So, instead of you doing asset allocation, you can invest in a fund like a multi-asset fund, and the fund manager then takes the call and increases or decreases the asset allocation. And we just did some work on that. If you look at a 3-year rolling CAGR of the entire, like this particular fund has a history since 2012, and then it has done pretty well. You have to see this as a alternative to fixed deposit. Instead of keeping 3-year money in fixed deposit, can you take slightly higher risk and get allocated to equity, debt, and gold, which can try and beat a compounded fixed deposit returns over a period of time. That's the objective of an asset allocation fund. Plus, it just makes your life easy. You just end up allocating to this fund, but you need to manage your expectations. It is not equity fund, so it will not give you that 100% return that equity funds did, from the way down and up last year. Right. So you need to balance, but it has lot lesser volatility than a typical equity product. So.
Right. Arvind, it's always a pleasure talking to you. Thank you so much for your time. One disclaimer for our investors is that, or for all our listeners is that, investments into mutual fund is subject to market risk. Please read all scheme-related documents before investing. And thank you, Arvind, for your time. It's always a pleasure talking to you.
Thank you, Jignesh. Thank you so much.